and societies start to break apart. So I'm not interested in investing in anything. I'm interested in divesting because I see everything is about to collapse. By divesting, I mean getting out of all debt, right? And the dollar itself is an instrument of debt because all dollars that are issued that exist today were brought into existence in exchange for treasury bonds that the Federal Reserve bought. So the dollar is debt, and therefore to invest in dollars, to hold dollar cash is to invest in the system. And if the system's going to fall, then you're going to have to get out of all credit, which includes the U.S. dollar, and get back into money. And the question is, what is money? And people have been so polluted onto as to what even money is that nobody knows what it is anymore. And people think that money is stocks. People think that money is debt. People think that money is bonds. Worse, people think that money is nothing. It's just a point system, or that it's Bitcoin, a series of numbers in a chart that for some reason people think have value, but they don't realize that everything is connected to the past and all prices are connected to the past. So
Gold and silver's underperformance against mainstream equities has been used to argue that precious metals have lost importance in portfolios for over a decade. Since 2011, broad stock indices like the S&P 500 have achieved strong returns, especially after dividend reinvestment, supporting the idea that metals are relics. It often ignores the long history of money. Currency crises take time. Decoupling money from tangible backing, particularly the 1933 U.S. gold ownership ban, began the decline of purchasing power. Political expediency, monetary easing, and debt accumulation have expanded the inflationary monetary regime since this decision. Rafi Farber, author of The Endgame Investor, believes gold and silver are not only financial vehicles. He explains that gold has historically preserved purchasing power across generations. Its purpose is to maintain value during currency regime instability, not to beat equities in bull markets. Silver is fickle, yet it offers tactical advantages during extreme disruption. Farber believes the monetary system is collapsing owing to its contradictions, and that metals will not keep rising in value. They will resume their economic role. This evolving financial landscape suggests precious metals aren't falling behind. Prepared to wait, they await the decline in debt-based money confidence. When money urgently swings toward tangible value and investors and nations recognize paper wealth's limits. Rafi Farber notes that subtle indicators like the progressive withdrawal from U.S. Treasuries, the growth in tangible premiums, and the increase in central bank gold purchases may signal this tipping moment. Gold and silver will catch up to stocks and act as lifeboats when this subtle change becomes apparent. Rafi Farber's interview excerpts follow. To receive timely updates before our discussion, subscribe to our channel and activate the chime symbol. Hope you enjoy the video, and thanks for helping.
I'm looking at the precious metals versus mainstream stocks, which is the precious metals are only now just starting to outperform stocks. They haven't been since 2011. I'm watching the Fed about to cut interest rates into a worsening consumer price environment, which haven't done since the 1970s. I mean, what happened in the 1970s. And I'm watching the whole world lose its mind and get more violent, and welfare recipients get more crazy by the day, and societies start to break apart. So I'm not interested in investing in anything. I'm interested in divesting because I see everything is about to collapse. By divesting, I mean getting out of all debt, right? And the dollar itself is an instrument of debt because all dollars that are issued that exist today were brought into existence in exchange for treasury bonds that the Federal Reserve bought. So the dollar is debt, and therefore to invest in dollars, to hold dollar cash is to invest in the system. And if the system's going to fall, then you're going to have to get out of all credit, which includes the U.S. dollar, and get back into money. And the question is, what is money? And people have been so polluted onto as to what even money is that nobody knows what it is anymore. And people think that money is stocks. People think that money is debt. People think that money is bonds. Worse, people think that money is nothing. It's just a point system, or that it's Bitcoin, a series of numbers in a chart that for some reason people think have value, but they don't realize that everything is connected to the past and all prices are connected to the past. So The simplest definition of money is the most liquid physical commodity that exists in an economic system. And because it's liquid, you use it to trade for other things. Because the reason that it's liquid is that it stays in the same form and that its value changes the slowest versus everything else. That's what makes it liquid. That's what liquidity is. So money is liquidity, and the most liquid thing is the best money. So what I am telling my followers is get out of credit and get into money, which means precious metals that you can actually have access to, and not credit derivatives of precious metals, which I'm not against entirely. I own some credit derivatives of precious metals, like ETFs. I own some of that. But in the end, I don't think those will survive either. They are good vehicles through which you can earn more credit through using them and then use that credit to get money if you want to play that game. But ultimately, you have to get out of all of it. And then once it all falls, then you can redeploy your money back into a credit system that will grow on top of it, but a more honest one that isn't so inflated with a bunch of garbage that we have now. Interest in a unit that doesn't make any sense. So whether they should be higher or lower, they shouldn't exist because when a treasury is a vehicle to pay future dollars in dollar terms based on a dollar that's already existing because it bought a treasury. So you're talking about a self-reinforcing loop. The treasuries are units to pay future dollars, which themselves are treasuries, which themselves are dollars, which themselves are treasuries, and so on and so forth until the whole thing spirals out of control. So, should interest rates be higher or lower? I know that these aren't like the answers that you wanted. You wanted me to give, a number, what interest rates should be. Well, I mean, we could play that game. Let's say if interest rates are, let's say, 20%, what would that do? That would collapse the banking system. Well, if interest rates are 0%, what would that do? That would collapse the dollar. So it's one of those two. One of those two is going to happen. It's not going to be collapsing the banking system because then the bankers will get very upset. Instead, it will collapse the currency, and that will collapse the bankers because when the bankers have no more dollars and their dollar can't buy anything, and they have banks full of dollars, they have nothing, and then they'll collapse anyway. End of this, no matter where interest rates go, higher or lower, means the banking system is going to collapse. And when the banking system collapses, that means everything is reset. All valuations of everything will be reset to money and not to credit. And the question is, who will have the money? And the answer is whoever has the gold and silver, they will be able to use their liquidity to acquire whatever capital remains, and everything will be redistributed based on who has the money and not who has the credit, because the credit will be worthless. Silver have not been performing well at all. Not at all. They've been horrible, and they're still horrible. Because if you look at the valuation of gold and silver relative to stocks, if you just had a stock portfolio since 2011, so first of all, on a long term, since the 1970s, and also if you count since 2000, yes, gold and silver have both been performing better than stocks. Yeah, that's true. But they have not been performing well, and they're nowhere near, not even close to their tops relative to stock portfolios. If you have a guy and he just he has a 401k or whatever he has, and all he did was just invest in the S&P 500 ETF, and that's it, nothing else. Just kept reinvesting in that, investing his profits into that. He'd have a lot more money than if you invested in gold since 2011. So no, gold has not been performing well at all. Neither has silver. If you look at silver relative to the S&P 500, it's almost nothing compared to what it was in the 1970s. Silver has not been performing well. So if you look at the dollar number, yeah, it looks like it. But if you're gonna compare it to someone who has been investing in mainstream stocks for the last 15 years, it's been doing horribly. So I expect that to change very quickly. And once we see that gold and silver holders, those who have physical gold and silver tucked away somewhere and they don't have any stocks, once they can say they have more purchasing power than someone who's been reinvesting his dividends and his excess income into the S&P 500 for the past 15 years, once gold and silver holders say, you know what, we have all the purchasing power. You, the guy who has the S&P 500 or the Nasdaq or whatever, you've lost it all, and that'll be the end. So if that's what I expect to happen, so is there still time to own gold and silver and to participate in the rally? It's not really a rally; it's just a sucking of purchasing power away from mainstream stocks into money because of the death of credit. Yeah, there's time. Not much, but there's time.
Mike Maloney, a seasoned commentator on monetary history and precious metals, has emphasized the significance of a chart that was initially published in mid-2022. The chart illustrates the significant amount of liquid capital that is awaiting a shift into gold and silver. The figure was nearly $16 trillion at that time, significantly higher than the $7 trillion indicated in some later reports. This was attributed to the extensive pool of immediate access money, which included currency, demand deposits, and unused credit lines. In a mere 3 years, this container expanded by approximately $4 trillion, with the most liquid segment, money markets and short-term funds, increasing by approximately $2.5 trillion. The message is evident to Maloney. At the initial indication of instability, there is an unprecedented amount of capital available to be invested in safe haven assets. He emphasizes that this phenomenon is not exclusive to the United States. Similar dynamics are occurring on a global scale, as liquidity, credit lines, and currency reserves have expanded into the tens of trillions. This results in a larger potential capital transfer into precious metals than many market participants are aware. Maloney warns that such actions ordinarily occur in spurts that are precipitated by financial disruptions or geopolitical events, and the current fragile environment offers an abundance of catalysts. He believes that the world is on the brink of a tipping point, at which point gold and silver will not only increase consistently, but also surge as pent-up liquidity surges into them, potentially igniting a market-redefining rally. We should return to the interview.
Book. So this was done in the summer of 2022. 16 trillion, not 7. Wow.
Exactly. And the chart we were just looking at, that was 7.5 trillion. That was basically the yellow section here, but 3 years ago. So between about 7 and 12. So maybe there was only about 5 trillion in money market funds 3 years ago. Now it's up to 7.5. But what about the blue and the green areas? They have grown as well. So let me show you that. Are you ready to see it?
Yeah, this is... for everybody out there, I have not seen this chart, and I do not know what the number is. This is a surprise.
Okay, so right now, the old total was just about 16 trillion. The new total, just over 20.
Whoa! Look at that growth. And wow, the growth in the money market area, the yellow, is absolutely insane. Currency plus demand deposits and unused credit card lines. So this is... these are dollars that can, within a day, come chasing the safe haven asset in a crisis, and a crisis is coming. October is always the spooky month. We're in September, the end of September right now. October is just famous for crashes. And I really think that we could get a crash as early as this October.
It's definitely possible.
In that case, a bunch of this is going to come chasing gold and silver. Okay.
Exactly. And just to put some numbers in it for anyone curious, the green area grew by about 1 trillion, the yellow by about 2.5, and the blue by almost another 1 as well. So in total, it grew by 4 trillion in just 3 years. And as we said in that previous video, it grows before a market crash. So this is investors sensing a crash, and it rises a lot right before a correction or a big crash. So to your point, we absolutely could be getting it soon.
Okay, so the point of some of this, the point of our book is that this time it really is different. You hear this all over. Well, this time it's different, and it turns out that it never is. But this time it really is. The growth of the currency supplies, gold and silver could just reach astronomical prices because of not just the growth of the currency supplies, but the number of people that are able to chase after it. It's 18 times more populations is what we calculated, because it was illegal in most parts of the world, or it was the populations were so poor they were starving to death, and there were no exchanges that could affect the price. In order for the spot price to be affected, there has to be a purchase or a sell on an exchange. And we looked around the world, and man, this time it really is different.
Yeah, absolutely. Well, speaking of looking around the world, after I updated this chart, I was thinking, wait a minute, this is just the United States. What about the rest of the world? And so I sort of asked and did some searches and put together some data about all the currency and the other asset classes globally. And so this bar right here, currency, this is basically what we were just looking at. It includes the
Wow.
20 trillion in the United States, but it's up to about 80 trillion total globally, because obviously all that
Whoa.
currency all over the world, that can come chasing gold and silver too.
Wasn't
So,
it like 53, 55, 56 when we did the book?
well, I know that this amount grew by roughly a factor of 55, but I can't remember nominally
Wow.
what it was. It must have been a lot smaller.
Okay.
Yeah.
Amazing. And there's gold and silver. Wow. Explain some of this then. Okay. Obviously, real estate around the world is huge. So bonds and stocks, a lot of that. Bonds, stocks, and currency. So on top of money market funds and currency in circulation and
And
money
unused
market.
credit lines.
Yes. Unused credit. So currency that doesn't exist yet, just promises by banks that they will create that currency for you if you want it. So 20 trillion. And then to that, you have to add what people can get for selling some of those stocks and bonds, because some of them will. I want to remind everybody that I believe right now that gold is about 0.5% of global financial assets. And in 1980, it was about 8%. So it could grow by 16-fold if the same thing happened as in 1980. But as we know, this time it is really, really different.
A significant repricing of gold and silver is anticipated as a result of the increasing global liquidity. Given the substantial amounts of capital that are currently dormant in highly liquid instruments, even a minor transfer of this money to tangible assets could result in a significant surge. The current environment, which is characterized by increased debt, currency instability, and geopolitical tensions, has historically served as a magnet for precious metals when trust in financial systems is eroded. A structural revaluation that repositions gold and silver as fundamental safe havens in an era of deep uncertainty would result, rather than a mere price rally. In the future, the trajectory of these metals appears to be asymmetrical, with a limited downside and an outsized upside. In the event that traditional markets experience a decline in confidence, capital inflows could arrive in surges, causing silver to reach levels that surpass historical benchmarks, and gold to enter a realm that redefines its role in global finance. This would manifest as an abrupt repricing event rather than a gradual ascent, as liquidity begins to migrate in large quantities. The magnitude of the money that is expected to be transferred indicates that the repercussions will be both extensive and rapid, influencing the perceptions of tangible assets by investors, institutions, and nations in the years ahead. Please provide your perspective on the analysis conducted by experts in the remarks section below. If you find this video to be informative, please consider supporting us and activating notifications to remain informed about our most recent videos. I will see you in the video that follows. I appreciate your attention.